So, what's my stock market forecast? Just to touch on this real quick, because all the markets are somewhat correlated. I think stocks are in for a little bit of a tough year. Obviously, all the major indexes were up over 20% in 2021. But like we've seen in the past, when the Fed goes on a height rate cycle, what it does is it causes what's called price to earnings multiple contraction. And you can see that stocks currently, by a lot of different measures, are overvalued. They're extremely expensive. So, could be in for a little bit of a tough year in the stock market. Forecast is about a 10% decline. When we take a look at what's going to happen with interest rates, this is a chart that I made, and I really did some digging here and looked at some price history of the last time the Fed went through a rate hike cycle and what happened with the market. So this is a chart of the 10-year. And you could see here, back in December 2016 of 2015, the 10-year was right around 2.3%. The Fed hiked the Fed funds rate by 25 basis points. You could see what happened with yields. Yields moved lower. But then the Fed waited a full year until they hiked rates again. And what happened during that time? The economy picked up, inflation reared its head again, and rates moved up. But then look what happened here where the Fed hiked rates again. They hike, inflation moves lower, and rates move lower. But then remember I said there's one X factor out there, and that is the Fed reducing their balance sheet. This is something that we have to keep an eye on as far as how much they reduce it and what impact it has on the market. Because if you look at this chart, this yellow line here is where the Fed started to allow the assets on its balance sheet to run off. So why does the market not like that? Well, you have one of the biggest buyers out there of mortgage bonds and treasuries, which has been keeping rates low, not only not buying anymore, but not doing the reinvesting that they were doing and allowing that to run off their balance sheet. What does that do? It causes more supply in the market that has to be absorbed, typically at a lower price. Lower price in mortgage bonds means higher interest rates. So what happened to rates after they started runoff? You could see rates started to move higher. But then in May of 2019, they slowed the pace of the runoff, and you could see the improvement. And then in July of 2019, they stopped the runoff altogether, and they actually started to reinvest in mortgage bonds and treasuries, and you could see yields move lower.